In this high-stakes economy, it's not uncommon to see rates fluctuating up as well as down. You never know what cards you're going to be dealt. And that's why in today's show, we're going to be teaching you when to hold 'em and know when to fold 'em, know when to walk away and know when to run.
All right, David. So I got a house, full house, actually.
All right. I see your full house, and I'm going to raise you 1 1/2%.
1.5% on the rate. Huh? I'm going to call you with a rate lock.
Dang it. This guy knows how to play poker. Where did you learn this?
Mortgage Mondays. We got a good one in store for you.
Christian Batchelder, welcome to Mortgage Mondays. How are you today?
Another one coming at you guys. I'm doing well. Thanks for having me.
Glad to hear it. Okay, we are going to be talking about one of the challenges that can occur to a real estate investor. And it can sometimes happen when things go positively in our direction. So sometimes rates go up when you're in escrow, and that can suck, but we're going to talk about what you can do to protect yourself when that happens. But sometimes they go down, and there are ways that you can take advantage of this and then ways you can't. So there's a lot of questions about what to do if rates drop. Some people think that if rates drop, that your rate is floating and you're just going to get whatever rate it dropped to. That's not always the case. So in today's show, we're going to be getting into how to handle rate changes when you're mid escrow. You ready to do this?
Absolutely. Yeah. Great topic for especially our economic environment that we have happening right now in today's market. So excited for this one.
So let's start with that. What are you seeing in today's market?
Just so everybody's aware, we just had New Year's. I know these go out a couple weeks after we record them. Over the last, let's call it 60 days, we've had between a 1.5% and a 2% rate decrease. Rates were peaking, I want to say maybe October, November range. They were peaking around 8%. We're now in the lower sixes this is just for a conventional like primary residence home. So that's a very significant drop over a short period of time. And just like we've explained in previous episodes, it's not because anything necessarily has changed in December. It's because the news forecast has changed, right? We've discussed this a lot where mortgage rates and the Fed funds rate, it prices on news and anticipation, not necessarily current events. So we anticipate rate decreases going into 2025, and the Fed has kind of, verified that number of times. And that has led to banks starting to say, okay, let's bring it down in anticipation of the market that we're going into, which is a good thing for buyers. But as David and I are going to get into, it can lead to some unique challenges.
Now, sometimes when rates drop, like what we've seen recently, you're in escrow. So you may have gone into escrow when rates were at 7.5% and then be blessed by an opportunity where they drop to 6.5%, say. In what circumstances can somebody say, hey, I want to get the better rate before I close? And in what circumstances is someone stuck with the 7.5% and why?
This is something that a lot of people find themselves in, especially when we have very short, term changes like what we just experienced, right? 2%, almost 2% over 2 months is a very quick change. And like you asked, David, so if you're in escrow, the biggest thing you need to be paying attention to is number one, what type of lender are you working with? And number two, is your rate locked or floated? Those industry terms, I'll explain what each one means. Floated means you're leaving it up to chance, right? You don't have anything locked in. You don't have a guaranteed agreement in place with your lender for the rate that you're going to be offered. You're floating it, which just means you're going to take it where it lands. You cannot close a loan on a floated rate. You have to lock it to close. But what some people do is they float it during escrow. Okay. When I first started in the industry, we were in a very short period of time where rates were slowly decreasing. What I used to do is I would float rates during escrow because chances are it's going to be lower than when we started escrow. Now, a good loan officer, and I won't say a good, but an experienced one that has ways that they monitor the market and can kind of stay up to date on things, will do a kind of a mix of both of these. They won't lock it on the first day. They won't float it until the last day. They will regularly monitor and maintain the market throughout the 30-day escrow, and they will pick a day that is the most likely to be the lowest rate. And you can lock your loan at any point in time during your escrow.
So what does a loan officer do to protect their clients when they go into escrow from rates going up?
Yeah, and that's what we refer to as the rate lock. A lock means you are now committed to that rate. That means you have selected a rate, the lender has locked the loan. That is the loan that you're going to get with that interest rate. Okay, going forward for the next 15, 30 years, however long your loan period is. Obviously, you are locking a loan on a specific day. Rates change every day. Sometimes they change by the hour. Okay, but when you lock it, it cannot go up and it cannot go down. But obviously, Either of those things can happen in the market, but you are committed to one.
So if rates drop before the rate is locked, you can get the lower rate, correct?
Yeah, if you were floated. So floating, you're leaving up to chance. If it drops and your loan officer is doing his job and monitoring the market, he can lock it on a low date. And if it increases in the future, that doesn't impact you. You are locked.
Okay, gotcha. Now, what happens if you've locked in your rate to protect yourself from rates going up, but instead they go down? Can you go back and unlock?
This is where we get into the flexibilities of the lending world. With most lenders, no. If you are locked, you protect against the upside, but you also limit your ability to take advantage of the downside. Okay, so that's if the rates come down, you cannot come down with it, just as if rates go up, you're protected from that. However, there are some options. If you're working with a retail lender, now this is the Chase, the Wells Fargo's, the Bank of America's, the lenders that typically you go direct to one lender. When they lock their loan, they lock you in their lending environment. They lock your social and that property address, right? You are locked for that deal. That means they cannot cancel your loan and resubmit a new one because it's not just that file that is locked, it's actually your social and that property address that's locked. With a broker, however, our world operates a little bit differently, where if we have you locked with lender A, you're locked in their world, but rates come down so significantly, we can do what's called a resubmit, which is where we take you to another lender who has never seen you, doesn't know anything about you, and we lock you over there. Okay. Now that's where brokers can kind of pivot and do some things that retail lenders can't in the industry. However, I want to preach some caution here because we will tell you you can't do it if you're sub 10 days from closing. Because you guys have to imagine if you're in a 30-day escrow and you waived your loan contingency and you have no protection for your deposit, and now rates have dropped and you only have 5 days left in escrow, we can't cancel and resubmit and order a new appraisal and get everything done again in 5 days, right? It's not going to happen, and it's going to violate the terms of your contract and put your money at risk. And we will never do that. We're going to protect your money as our customer first and foremost. In that event, maybe you can negotiate, maybe you can work with the sellers on extending escrow, but we need enough time in order to resubmit you.
There you go. So a lot of this has to do with what stage you're at with your loan officer. Has a loan been submitted already? Has a lender already been chosen? And has a rate been decided on? As well as where you are within the real estate agreement with the seller. Are we at a position where we have enough time to change lenders before you're going to close? Now, let's say that there's a significant rate drop. So there's a lot of skin in the game for the buyer where they really want to get that better rate, but they don't have a lot of time before they're supposed to close with the seller. In this case, you may need to negotiate an extension between the agents. Now, sellers aren't going to just be like, yeah, that's great. You can have another 2 weeks to get a better rate, because that doesn't benefit them. They probably want to hold you to the contract, especially if you don't have a loan contingency or it's been waived, which restricts your ability to back out of the deal and get your deposit back. So what options are you aware of when it's close to the closing of escrow? There's no loan contingency. The buyer doesn't have protection, but they still really want that rate drop.
Yeah, this is a really good question. Now we're getting into the weeds a little bit. This is where a strong realtor can make the difference. But this comes down to negotiations. So for instance, with us, I'll list a couple of the items that we've used. We've done things like a per diem. Okay, what that means is that I'll pay $100 per day, and I'm the buyer in this case. So let's say, David, I'm buying your property. I'm the buyer, you're the seller. And I say, hey, David, I just got news that I can get a 1.5% lower interest rate, right? My loan officer told me it went from 8 to 6.5, but we need to restart the process. This isn't any, inclination that I'm a bad borrower or that we have problems financing. This is literally just, I can save an enormous amount of money over the next 30 years by getting a lower rate product here. I would like to compensate you for allowing me to get this product in the manner of giving me a longer time in escrow. I'm open to paying you $100 per day, and I'm going to need 15 more days to close this escrow, right? So you're going to make an extra $1,500 on your purchase to just wait 15 extra days. I'll waive my appraisal contingencies. We can still do all the contractual agreements. I just need more time because we have to submit with the new lender. And in the event we can work that out, you tell your loan officer that we have an extra 15 days, they get ready to rock, and they get that thing closed at the lower interest rate for you.
All right, so that's the per diem option where you can pay the seller per day to extend the contract, which means it benefits you because you're getting the better rate, and it's going to benefit them because they're going to get more money on the sale, especially if that better rate is going to save you close to $100 a month. That's almost a no-brainer for the buyer to pay that because they're going to get that savings for every single payment in perpetuity for the amount of time they have the loan, right? Now, there's also the option of just giving somebody a lump sum up front. So do you have any advice for if the seller doesn't like the per diem option, or maybe you think that it would be better to just say, hey, I'll increase the purchase price if you're going to extend my contract?
Yeah. So two options. I mean, you could just wrap it up in escrow and say the buyer's going to pay the seller an extra $1,000 at closing or whatever it is. You can also just upfront, right? If you just contact him directly and you say, hey, if I give you $1,000, can we just get this thing extended for an extra 15 days? David, what would you do if this was your buyer? How would you negotiate this?
The first thing that you need to understand is having a verbal agreement with the seller is not enough. So many sellers might be like, oh yeah, that's cool. You can take a couple more days and you think you're good, but you're actually out of contract, which means you don't have leverage and your deposit could very well be at risk. So you want to make sure that you get this officially done. What you want to do is ask for an extension of the close of escrow or an extension of your loan contingency if you still have it. And you're going to ask for a certain period of days. You want 10 more days, you want 12 more days, you want 21 days, whatever the case would be. And then you wait and see if the seller says yes. Many times they'll agree, especially on the first one, if they think that it's that or nothing. If they want to close and they're like, hey, this person needs more time, they might just give it to you and it could be free. My advice there is to have the loan officer call the seller and take ownership of the problem. If they say no, that's when you're going to say, okay, fine. What if we give you an extra $1,000? What if we give you an extra $1,200 on the purchase price to buy ourselves an extra 2 weeks? Or you could say, hey, fine, we'll give you $100 a day until we close so that you don't have to worry about if we're actually going to close. Your seller's going to get more money. Usually that will be enough for the seller to say, oh, great, I actually get to close on this deal and I can get some extra money for being inconvenienced. I'll agree to it. The key is to have your agent and your loan officer working in tandem and to get this in writing with official real estate documents. Christian, anything that you want to add and advice you have for people of negotiating real estate when you're in an environment where rates are changing often like this?
Yeah, I'm hoping you guys are hearing how David broke that down. Clear, easy to understand, obviously has experience negotiating. The power of a good realtor and loan officer tandem in this situation would be the difference of giving you an opportunity to save 1.5% a year on your mortgage. I mean, you're talking tens and potentially hundreds, depending on your loan amount, of thousands over the course of 30 years. It's an insane amount of money, right? And literally that is on the balance of a needle's tip. Just, do I have a good agent that can get this done for me? Do I have a good loan officer that's going to let me know this is possible or not? It's that simple to go one way or the other in this industry. So make sure, guys, there's a lot of good people in our industry. Partner with one that gives you confidence that you know you're being represented well on.
Now, a lot of people think, well, hey, I'll just close on the deal and I'll refinance later. So I'm locked in at 7.5%. I need to close. I'm getting a great deal on this house, or I don't want to lose this property. I'll just refinance afterwards. Is it as simple as that, Christian, that they're just going to refinance after the deal?
Yeah, some loan officers may be mad at me for this one, but in the effort of honesty and transparency here in the industry, a lot of loan officers and lenders will tell you you cannot refinance for 6 months. Many of them will. The reason being for that is actually what's known in the industry as an EPO. It stands for an early payoff. What that means is that if that loan is paid off via you selling the property or refinancing within the first 6 months from you closing, the loan officer that originated your deal actually has to pay back his commission. So in the event we are where we are right now, where you got a loan in October at 8%, and now there's a loan option available at 6%, that would be worthwhile to refinance. That's a 2% rate drop. That's significant. The downside is that your loan officer would have to pay back his commission. Loan officers don't want to do that. So in the event you do, it is always preferred and really kind of the right thing to do to go back to the loan officer that did your first deal. Okay, because it'll basically net out for him. He'll make his commission on the new loan, but have to pay back his old loan, and it zeroes out. You get the better rate. If you go to a different loan officer, the first one that you close your purchase with has to pay back the entirety of his commission, and then a new guy makes money on it, which means the first guy who helped you acquire the property in the first place goes home with no income, which is that's not right? So it's not that you can't refi within 6 months. It's that, you know, loan officers say that so they don't have to pay back their commission, but you can theoretically. And on top of my side of things, the loan officer side, what does the borrower have, right? So when you refinance, a lot of people think you hear like no cost refinance. No, every refinance has a cost. There's title fees. There's the cost of actually ordering the appraisal. There's the cost of putting the new loan on the title, which has to happen in the city recorder's office. That stuff's not free. So when you refinance, there has to be a benefit to you to justify a refinance. So going from an 8% to a 5% is a no-brainer. But going to an an 8% to the 7.5%, you're going to pay probably a few $1,000s in fees to do that refinance, and you're not saving enough. Just remember that when you go to refinance, don't just say, oh, I can drop my rate by 0.25%. No, you have to justify enough savings on the drop of the interest rate to justify paying the costs of the refinance. Okay. And I've done some numbers, just some crunching. I've found that to be around a 1 to a 1.5% decrease in your interest rate to justify doing the refi, right? Doing it for 0.5%, like I said, is not going to make it worthwhile. So if you're in an environment like that, if you got an 8% on your primary and you're seeing similar loan products available right now for a 6.5%, reach out to a loan officer. It may be worth looking into a refinance.
All right. So just generally speaking, on a $400,000 loan balance refi, what's a range that a borrower could expect to have to pay in closing costs?
Let's say 2 points, 2%. So that's $8,000.
So that's a pretty significant amount of money. If you're like, hey, I want to refinance into this lower rate after I close, it could cost you around $8,000 that may come out of your pocket or may be added to the loan balance if you have enough equity in the deal. But still, that's a lot more expensive than negotiating an extension for yourself when you're in escrow and getting that lower rate then. And that's why we're talking about this. We don't want people to assume that they can just close on the deal and then refinance afterwards. It's way more expensive and time consuming than to negotiate yourself an extension so you can get that better rate. All right, Christian, this is great news. If people want to reach out to you to learn more about getting a loan or questions about loans in general, where would you recommend they go?
Yeah, guys, you know us by now, theonebrokerage.com. Apply now button on the top right if you want to get in touch with the team. I'm on all social media at The One Broker. You can find me there. Reach out, send me a DM.
All right. And if you would like to get in touch with a real estate agent to help you with your deals, BiggerPockets has a way to help you. They've got a agent finder tool. You can go to the BiggerPockets website and look up agent finder under tools and be in touch with an agent in your area that should be able to negotiate a good deal for you. Remember, representation matters in these deals, and you want the experienced people that know what to do working on your behalf. You can learn more about me at davidgreen24.com or send me a DM on your favorite social media at davidgreen24. And remember, BiggerPockets has a lot of resources in addition to this. Go check out our forums, check out our blogs, and check out our store where you can find all kinds of books on different topics. If you've got a minute, check out another Mortgage Monday video where Christian and I are bringing you the skinny on the mortgage industry and what you need to know to save money in lending and get better deals. And if you don't, we will see you next Monday on Mortgage Mondays.